Today, we're digging into a really interesting and pretty bullish case for SoFi stock. This is all based on one investor's detailed analysis of where this company could be heading.
And this central claim here, it's a big one. We're talking about a potential path for SoFi to hit $100 a share. Yeah, you heard that right, $100 all by 2026. So the big question is, how on earth could it possibly get there?
Okay, so here's how we're going to break this down. First, we'll look at that main claim, the path to $100. Then we'll dig into the foundation of it all, the organic growth. After that, we'll talk about two huge catalysts that could pour some jet fuel on the fire. And finally, we'll wrap up with the big choice this leads for investors: patience or potential regret.
All right, first things first, let's really lock in on the central claim here. Because according to this analysis, this isn't just some pie-in-the-sky number. It's a thesis built on the idea that a very specific series of events is right around the corner. And the core belief is that all the right pieces are falling into place, creating what this investor calls a clear-cut runway for growth. The key word there is runway. It's meant to feel like a tangible, visible path, not just some fuzzy hope. Okay, so let's move on to the foundation of this whole argument. This is the part that the analysis sees as the most reliable, almost predictable piece of the puzzle. We're talking about Sofi's own internal momentum. You know, the person who put this thesis together actually calls this the given part of the whole thing. This is the growth that's expected to happen just based on how the company is already performing. Think of it as the baseline, which should happen even if SoFi gets zero outside help. It's kind of framed as the guarantee.
So if you look at this timeline, it's projecting a pretty massive shift based on that organic growth alone. The argument is that by the middle of 2026, again, with no outside boosts, SoFi can be pulling in quarterly revenues of well over $1 billion. And when you hit that kind of number, it completely changes the financial story of the company.
So what's the bottom line here? The crucial point is that SoFi is already seen as being in this incredibly powerful growth stage. This internal momentum, from its loans, credit cards, and all that, plus a good market for banking stocks, well, that's considered the engine driving this whole train forward.
But that's just the engine, right? Now let's talk about the jet fuel. According to this analysis, there are two huge external forces that could pour jet fuel on that fire, launching the stock into a totally different stratosphere.
So, you've got two big ones. Catalyst number one is what you'd call a macro tailwind. Basically, rate cuts are expected in 2026, and that's good for pretty much all banking and housing stocks, including SoFi. But it's the second one, index inclusion, that's framed as the real game changer here, the one that's specific to SoFi. So what exactly does getting into the S&P 500 even mean? Why is it such a big deal? Well, in this argument, it's not just about bragging rights or prestige. It's about a powerful, almost automatic effect that it sets off in the market.
And this is how that chain reaction works. It's simple, but it's powerful. Step 1. SoFi gets announced for the index. Step 2. Every single index fund and ETF that tracks the S&P 500, and we're talking trillions of dollars here, is now forced to buy SoFi stock. They don't have a choice. They have to buy it to match the index. This creates this huge automatic wave of buying.
Yeah, the analyst literally calls this forced buying a steroid for the stock price. 100%. They talk about boatloads and waves of money just pouring in. This isn't just a little bump in interest, it's a fundamental market mechanic kicking in.
Okay, now this is where it gets really interesting. The analysis takes a recent event that seemed kind of confusing and spins it as a potential clue. See, SoFi's reports have been looking really strong, right? So why on earth did they just go out and raise another $1.5 billion in a stock offering?
Well, the theory here is that this mysterious move is like leaving breadcrumbs. The idea is that maybe, just maybe, SoFi's management already has a good idea that this S&P inclusion is coming. So they're getting their war chest ready now so they can hit the ground running with new programs the moment that announcement drops, and all that cash and attention comes flooding in.
And this whole idea that the company might be playing 4D chess here leads us right to the final point of the argument. It's all about the psychological dilemma facing anyone watching this stock right now.
So the situation is framed as a fork in the road. On one path, you have short-term swing trading. The price is bouncing around, so there are chances to make a quick buck. But the other path is long-term holding. And the warning is that if you're only focused on those small, quick wins, you could end up with some serious regret if this whole big picture thesis actually comes true.
And this quote right here just nails the core message perfectly. I would rather have a lot more of SoFi in the 20s than I would at the $100 range. I mean, it doesn't get much clearer than that, right?
The whole point is that the current prices are being presented as a golden opportunity, a valuable entry point before those big catalysts potentially hit.
And to really drive this home, the analysis uses this term, the strangers. The idea is that right now, the people invested in SoFi are a pretty small, tight-knit crowd. They know the company. But that S&P 500 inclusion, that would bring in the strangers, a whole new wave of big institutional money.
And here's the kicker. These strangers, the huge index funds, they're not going to be buying at today's prices. The theory is that they'll be forced to buy in at $30, $40, $50 a share. And it's their buying that will keep pushing the stock higher and higher. It's that institutional money that would completely change the game for the stock's valuation. So, in the end, this entire detailed analysis really comes down to one simple but pretty provocative question. Are you in before the strangers arrive? It forces you to think beyond just today's numbers and consider a future where a tidal wave of new, obligated buyers could be heading this way. And it really just leaves you with that one thought. Where are you going to be standing when and if that wave finally hits?